Hastings Technology Metals Ltd, ASX HAS on the Australian Stock Exchange and 5am on the Frankfurt Stock Exchange is a technology company that's exploiting the rare earth assets that we have in Australia for export overseas. And joining me right now is the Executive Chairman, Charles Lew. Welcome, Charles.
Thank you very much.
Now, you've got some exciting recent news about a company with taking an offtake agreement in your asset. But before we talk about that, let's just talk about who Hastings Metals is and what the strategy is.
Yes, Hastings is a rare earths mining company where the ore body is high in neodymium praseodymium, which is otherwise NdPr in the chemical symbol. These two elements are critical in the need to make permanent magnets, which goes into electric motors, which goes into electric vehicles, and wind turbine, clean renewable energy, which is really very much the topical theme at the moment from a global environmental as well as e-mobility perspectives. Because of the high 41% NdPr in our ore body, it leads to basically, relative to our peer globally, a very high basket price, and our basket price compared to some of our peers is somewhere like double or 75% more value than our peer group.
So that's really important to go over for investors, because your concentration of the most commercially viable substance, or the most commercially viable rare earth, is the one that they're using in the magnets for the cars, and as you point out, the iPhones and all the solar wind farm generators. And so it's a very high value content that you'll be processing, and so therefore there will be a lot of global demand for this product.
Correct. We already seeing that demand coming through. We've got discussions for offtake with the Europeans as well as the Japanese and Chinese. We have announced offtake with the German industrial group called Thyssen
Which
Group,
is exciting news.
and that is for 5,000 tons of our carbonate a year for 10 years. That is all publicly announced. We also have offtake with 3 Chinese rare earth producers for 6,000 tons. And essentially what it means is that about 70% of our production of 15,000 tons a year of the carbonate is already under offtake. And what we'll be looking to do is probably bring that up a bit more by looking for other offtake customers, which the offtake in itself will help to finance the construction of the mine. So we are in the construction stage now, having completed our DFS back in November last year. We have also acquired the accommodation village. It's a 250-room accommodation village under construction now. We are going to procure very soon the sulfuric acid plant and the rotary kiln. All this leads to the construction of the production plant that will come into production into second quarter of 2020, probably March, April time.
Which is astonishing, how fast that you can get a mine up and running in 2 years.
Well, it's taken us 4 years to get to where we are here in terms of all the exploration work, the DFS, which includes the pilot test work, right? We did a lot of pilot plant testing in terms of the beneficiation and hydromet. So there's about 4.5 years work there, and then now is another 2 years work in the run-in to actually construct the mine and go into production.
Can we just touch on the long-term financials for a second?
Yes, we've got in our website PowerPoint presentations that help explain that, but in a nutshell, because of a high carbonate price, the price is about $29, $28 US now. Our OPEX costs is about $15, and then there is assumption of about $2.50 to $3 needed for financing costs and sustainable capital, and then there is another $2.50 or $3 again for the separation cost, because we don't do the separation in the individual 17 oxides. We produce the carbonate here in Australia on site in Yangibana, Western Australia, and then we sell it to our customers. Our customers take it out there and do the separation themselves. So we don't take that part of the risk. Effectively, when you work the numbers backwards, if you take a $28, $29 basket price for our ore grade, the carbonate, minus of the $15 for the OPEX, $2.50 or $3 for the financing costs, another $2.50, $3 thereabouts for the separation costs. It works out to be 28 minus 21, you're going to get $7, or if it's $29, then it would be obviously $8 US per kilogram in terms of profit margin, pre-tax profit margins.
And so 2 years from a mine, big German bank financing and a very high value concentrate for export, I think, in the short term, investors are going to see good value with Hastings.
I would have thought so. That would be my immediate instinctive reaction to it. If you look at what we do, we don't do the final part of separation because that carries risk in itself. We are just doing the carbonate in situ in Australia, and we are able to sell that to our customers. And as I said earlier, we've got these Chinese customers, and more importantly, or equally important, the German customers that basically feeds into the German automotive industry for the next generation of electric vehicles that everybody is talking about. So I think from that perspective, with the current market cap of 200 billion Australian dollars, it in some sense is not fully valuing what the company will be when we come into production, because when you think about the fact that as I said earlier, the margin's about $8 US, so that equates to about 10 Aussie dollar per kilogram. It's quite easy to work out what the profitability of the company is, and therefore what is the potential, because the total mine size of Yangibana is 650 square kilometers. The 21 million tons of JORC resource that we have put on publicly announced only relates to about 10% of that 650 square kilometers. And within that 21 million tons of JORC resource, we have confirmed 5 million tons of reserves, and we are adding on another 2.5 million tons of reserves. In the next 2-3 months, we'll be able to validate that. And before we go into production, we'll have 10 million tons of reserves. So it's really taking the JORC resource, upgrading it into reserves as we go along, and because of the area being significantly huge, there's obviously a very long mine life ahead of us.
And it's also very interesting that you've stopped the exploration program and focused, not stopped completely, but you've focused on bringing into production once you've achieved a base level of value, rather than continuing to explore and expand your resource base.
Correct. So the reason and the strategy behind that is really to monetize what we have. It's no point spending a lot more money trying to keep expanding the JORC resource, because if you can't bring it into hard cash and valuable assets for shareholders, then all they see is just rare earth in the ground. What we want to do is bring it into production, monetize it, and return that value back to shareholders.
Fantastic. So for investors watching, Hastings Technology Metals Ltd on the Australian Stock Exchange's HAS. Charles, thank you very much for joining us today.
Thank you. Thank you very much.